So I mentioned last month, just anecdotally, that we'd seen decent tick up in activity, buyer activity in January, and and that's really reflected in February sales. So you'll notice a lot of these sales prices, median sales price, price per square foot, a lot of things jumped up quite a bit. If you look at the February numbers, I don't think that trend will necessarily continue up. I think it'll continue more flat. But we are seeing a lot of buyer activity and still limited inventory, especially Corvallis and Albany. It was interesting to look at statistics I was looking at Lebanon and Sweet Home, and they had like a total of 18 closed sales between the two cities in February, which is really, really low. And their inventory jumped up quite a bit. Sweet Home was pretty high, and Lebanon was pretty high, but Corvallis and Albany are both in the 1.5 months. It'll be interesting to see how the banking shakeout works, but I think if anything, that will limit rises in interest rates, is what I'm hearing through this year. We'll see. I know Bjorn and I were at a meeting today, and we've been hearing economists say, and the Fed's been saying, hey, we're going to raise rates at least 2 more times this year, but that might look more like one is what a lot of economists are saying. Is that, yeah. Anyway, we'll let that conversation for afterwards, but let me go through and just real quickly introduce people by name, but I'm really gonna let them introduce themselves and what they do here in just a second. So first we've got Damian Lynch, and he's lives here in Corvallis and actually operates quite a few syndications, mainly out of Southern California. We've got James Furlow. Everybody probably recognizes James. A lot of people should recognize him. He's presented a few times, local investor. And then Bjorn Beer, a broker with SVN, but he's bringing to the panel that experience in investing in syndications. So we've got, and James, I didn't mention, recently went to a fundraising conference in Kentucky, Louisville. And so got some good insight from that. So excited to hear some different perspectives. I'm going to hand this to you, James. But let's go down and each of you guys maybe give a 2-minute intro about yourselves and what you do.
Sure. I'm Damian Lynch. I work for Fiola Communities out of Los Angeles. We are a syndicator, done about 50 deals in the last 12 years. My personal background, I started my business experience in semiconductors and did 12 years selling to Apple Computer for a French-Italian company first, and then a Korean semiconductor company second. Moved into real estate after that because semiconductors are really no fun. But real estate's a lot of fun. And so about 12 years ago, my family, I started a syndication firm with my family out of LA. It's a family firm. There's only 5 of us, and we focus mainly on workforce housing, apartments. Taking a C- and bringing it up to a B-. So all value add deals. I do acquisitions for them. So I do the underwriting, the property analysis, identifying the properties, finding the properties, and then I also do investor development relations for them.
Damian wears a lot of hats and excited to dive in and ask him some more questions. And again, open to questions from you guys as well. James.
Yeah, I'm James, and let's see, I started investing in 2009, couldn't have timed it more perfectly, and I was working for HP at the time as a data scientist, so I like the analyzing as well. And throughout the time, just kind of slowly saved and invested, and I've now bought about $4.5 million worth of real estate. And so in 2019, I was able to quit my job, and I hung out with my kids for a bit. And my whole goal in 2020 was to relax and take a long vacation, and the rest of the world joined me in March, which was fun for me. And and then about middle of last year, I was watching what was happening with all the markets and recognized that it's not sustainable and something's going to change and happen. And I get really excited when markets are volatile. And so I started looking into doing syndications because it turns out when you don't have a job, you're kind of limited on how much you can buy. And so I started down this path and have been taking a lot of classes and mentor groups and going to other events and learning. And so I haven't done a syndication yet, but I've learned a ton, and my goal is to do at least one this year.
And Bjorn?
I'm Bjorn Beer, like the drink. So I am a broker, an apartment broker. I focus on large apartments anywhere in Oregon except for Portland. And I got into this business in a weird way. I was in software for about 12 years, partnerships and sales, and kind of got burned out. And I decided I want to get into real estate investing when we moved to Oregon. And so I said, I have enough money to go to find, I'm going to find 6 duplexes this year. So I set an intention, I'm going to find 6 duplexes, and here's exactly what I want to buy. And then I couldn't find anything that cash flowed. And so I looked at slightly larger projects. And then the bigger I got, the more scared I got. And the more, I don't want to do this alone. I'm not going to take down a 10-unit loan. Through just networking and trial and error and looking at bigger and bigger projects, the first investment I made in Oregon, I'd done a few syndications elsewhere as a passive investor, but the first deal I did was a small percentage of a 50-unit in Beaverton, and then just projects here or there all over the place. So right now I'm a fractional owner of like maybe 200 units, which means I own probably one door. In this economy, maybe we'll see what I own. But yeah, we can get into the details of how these syndications work. But just short version is for me, and I don't want to project my experience onto anyone else, but for me, it was a good way to get in the game and diversify risk and upside as well.
Well, let's even take a step back and really start at the basics. Damien, do you want to explain what a real estate syndication is?
Sure. So, I guess I don't, because of what this room is, I'm assuming everybody here already values real estate as an investment option. But not all of us have 200 grand or 500 grand or $1 million to buy the property that we want to invest in. So a way for you to participate in some of the benefits of real estate investment, the security, the upside, is to split it up into smaller chunks. So what companies like mine do is our principals will sign on the loan, buy the property, and then syndicate out or sell shares out of that investment. So, for example, I just took down 8 units in it's in Garden Grove, so Orange County, and there are let's say 100 shares that we sell. We put it in an LLC, so it's liability. You get some liability protection, you get some bankruptcy protection in case one of your other assets goes down. And then we sell those shares out, and we let investors participate in the profit and the upside and the cash flow of the building. Generally, how these syndications work is the syndicator is going to pay you 8% preferred return of some sort for the use of your money while we hold your money. And then after the property turns, there is a profit split. So the sponsor, that would be my company or other companies that do syndications, they take a portion of the profit, and then the rest of the profit goes to the investors. So in a nutshell, that's what it is. It's a way to invest in real estate where you don't have to have as much capital up front. And kind of like Bjorn was saying earlier, I'm starting to do my own syndications here in Oregon with money that I've saved. I've been doing it for 12 years, and I've invested in almost every one of the properties that my company's taken down because I didn't have, $500,000 to take down a 12-unit deal. I didn't have, $200,000 to take down the duplex I had. So I'd put 20 grand in here, 20 grand in there, 50 grand in this one. And then after those properties exited, my money would double and save that up and then, start buying my own properties. But it's a way to get into real estate if you find a good sponsor with less risk, because you're splitting out the risk. You're not putting all your money or all your eggs in one basket, and you're still able to achieve some of those same returns or close to the same returns that the sponsor would get, or the person who's taking it down all on their own.
So you call it sponsor. What are some of the other terms that people might need to know as far as the GP, the operator?
Oh, yeah,
I mean,
okay,
it's kind of
okay.
a lot of terms.
Yeah.
And what are maybe the top three things that a sponsor, operator, GP does?
Okay, so you'll hear the term general partner or limited partner. The GP is the ownership side, the management side. The LP side is the investor side. So as a limited partner, your liability generally, and you have to do your own due diligence on this, your liability is limited to the capital you put into the investment. Hopefully, that's what your liability is limited to. Typically, yeah. You'll also hear sponsor, syndicator. I think those are the main terms. What the sponsor does, the sponsor is responsible for signing on the loan or having someone else sign on the loan. The management of the property. Generally, a sponsor, a syndicator is going to give you quarterly or monthly reporting so that you see how your investment is doing. Sometimes they'll hold informational webinars to let you know what's going on with the company, what's going on with the market. And then they're going to manage the property for you. They're going to clean the toilets and the units, turn the units, make sure that they stay rented. Your vacancy is down, your occupancy is up. They handle the litigation problems when you've got to evict tenants. So all of the headaches that a property owner normally has to deal with, your sponsor or your syndicator or your general partner is taking care of those headaches, and you sit back and cash checks. Ideally, if you find a good deal and you find a good sponsor. And I would also say, do your due diligence on sponsors. Do your due diligence on the people you're investing with, because I've had so many investors call me up and, hey Damien, I'm ready to reinvest with you on this deal, but I can only put in $50K because another sponsor just up and left for Aruba. So there are sketchy people out there. So seriously, do your due diligence. Make sure you're investing with someone that has a track record, is reputable. Hopefully you can meet them. Hopefully you can go and see the property that you're investing in.
And we're going to get into a lot of the due diligence aspect, and that's a lot of what Bjorn is speaking to. It has some stories tonight too. But Bjorn, as an LP or limited partner, what are some of the terms you hear as far as that, and what are some of, just real generally, what do you do as a limited partner, and filling in any blanks of what a syndication is?
Yeah, I mean, I think Damien, you hit all the points there, and I just wanted to add, you bet on the jockey, not the horse. So you got to find a good operator. You have to interview, do your due diligence. I think the operator matters more than the location. It even matters more than the deal sometimes. Like if you have a really good deal and a bad operator, it could be a disaster. And I have an example of an Albany deal that I can share. But there's other times where you could have a mediocre deal and a great operator, and they can turn it into gold. So I think finding the right operator is key. As a limited partner, I would just say there's this conception that investing in syndications is passive. That's the term you hear a lot, and I think it can be. And typically syndicators will start, not all, but many will start just pitching their friends and family, and then it'll grow, and you'll see their minimum investment requirement is $10,000, and then next year they do a few more deals and it's $50,000 minimum, and then 3 years later they're rolling and they're like, yeah, if you don't have 500 grand, you can't invest with us. So you see this life cycle. But even if you go the friends and family route and find someone you know, like, and trust, I think it's not entirely passive. I think, I've been in all the properties that I've invested in. I know the operators, I know who's doing the property management, I know who brokered the deal. I do my own rent survey. I have Rent-A-Meter, which I have as a broker, but I call market comps. I check everything. And you have to, because one little mistake and you could have a disaster. So, but the upsides are really good if you can find the right operators.
James, I know we've been kind of talking about structure and what they are a little bit, but can you tell us, and you've met a lot of people now going to some conferences, what are some of the, different options and what do these people invest in and what are some of the things that, you're interested in investing in as part of a group investment?
Yeah, well, I mean, anything's an option, really. And so the bread and butter, I would say, in syndications are apartment buildings, just because they're nice, they're stable. You get some good cash flow per door, which is good. And a lot of them are this value add where it's a property that was built 50 years ago and it's just gotten old over time and the current owners haven't taken good care of it. And so it is sitting at that C minus. But I must admit, I love the Ds, but it's sitting at that kind of level until you go in and you fix it up and you do a light repositioning of the project. That's like the classic type of thing. But there are a whole bunch of options. You can get into a development project, and I'm actually a limited partner in a ground-up development project, and which for apartment buildings. You can get into storage units. That's super popular, and you can do mobile home parks is another one. Another big one recently has been energy and putting together like investing in facilities that are doing something with oil, gas, things like that. And that's, for obvious reasons, that one's really hot right now. But pretty much anything that you can do as an individual investor, you can do as a syndication. They just tend to be on that bigger scale because you are pooling resources together, taking advantage of some of those economies of scale. And then to kind of go after, to follow on your comments, there are two different types of syndications, and we're gonna talk a little like regulation type stuff, but there's a 506B and a 506C, and as a passive investor, those are really critical to understand, and as a syndicator. So as a 506B, you are allowed to invest with people who are non-accredited. So new word, accredited investor. That's another one that's important to know whether you are or aren't. So an accredited investor, there are lots of definitions, but there's generally two main ways in which you qualify. The first one is you and your spouse have a net worth of at least $1 million. And I don't know why the government decided that money is the indicator, but it is. Or the second one is that you as an individual earn in the last 2 years at least $200,000, or you and your spouse $300,000, and you have a reasonable expectation that you will continue to earn that much. So if you meet one of those two criteria, and there's other ones in terms of like 401k amounts and things like that, but if you meet those, then you are, quote, an accredited investor. And that opens up all sorts of doors to you, because now you can invest in pretty much anything. So a 506c is one that is accredited investors only. And what that means is they assume that you're sophisticated, and so then the syndicator can do some general solicitation out to the market. They can say, we have this specific property looking for investors. They don't have to have a prior relationship with you. Whereas the 506B, which is relatively new, that's like in the last 10 years-ish, I think, is one where you do not have to be an accredited investor. A syndicator can allow up to 35 non-accredited folks. Now, the catch is you are not allowed to advertise for it. You have to have a prior relationship, and that term prior relationship is very fuzzy, and ultimately what it's come down to is I, as the syndicator, need to have a pretty good idea of where you're at financially in terms of whether or not you're accredited or not. It's not about length of time. It's not about meeting in person. It's not about like having kids who are in the same grade school. None of that matters. But I would say like those are probably the different types of investments in general that you can invest in.
Okay, no, that's perfect.
Enjoy that fire hose.
Yeah. No, then that's a really good point. I'm glad we brought this up earlier. You brought it up early about accredited versus non-accredited and the different types. Are there any and I guess one point, I think just to clarify, I think it's 200,000 a year in income, or 300,000 joint in income per year over the course of average of 2 years. You said something about 2 years.
Yeah. You have to be able to demonstrate that you earned that per year for the previous 2 years, and you have an expectation that you will continue to earn that per year for some amount of time.
Okay, and so there are some larger companies out there, and you might see or hear or whatever, Crowd Street, and there, and some other ones like that. But those ones are Fundrise, or those are generally for accredited investors only?
Yeah, those are syndications, and yeah, they do accredited only because they're advertising to the general public for specific deals.
Okay, great. Well, Damien, I know you've talked a little bit about some of the properties that you look at. Can you dive a little bit deeper, maybe even in the last property you purchased and how it fit into your buy box, or what caught your attention on it, and what that looks like?
So the process that my group goes through, we start with the numbers first. So I'll underwrite a deal. We've got a network of brokers in Los Angeles and Orange County. They're constantly pitching deals to me. Ideally, I've got a relationship with them and I'm seeing them off market or before they're widely marketed, and I get first shot on it. But I'm just looking at numbers. I generally, if I'm sticking a thumb in the air, it's 200 basis points between where I'm trading it and market. So can I improve the property 200 basis points in NOI? So if it's trading at like a 3.7 cap and I can move that to a 5.7 cap, and I don't know if I'm like if those are our terms that you guys recognize, but basically I'm improving the net operating income by a certain amount by improving the rents or decreasing the expenses. I need to see that much margin on a deal for it to make sense for me. So it's all about the numbers for me. So I underwrite it. I put in current rents and what I can do in 2 years, 5 years to improve the operations of the building. Yeah.
So without seeing the property, how would you determine that you could move any home? Just looking at
So I'm buying properties that are generally underperforming. So mom and pop operations, and LA is just full of these. Like in the 60s, 50s and 60s, when the baby boomers came back, they built all these apartments all over the place. So it's 68 and 16 unit buildings. And what mom and pop do is they develop relationships with their tenants. They don't keep up with market. So average rents for a one bedroom in Orange County, Los Angeles, let's say they're $1,800 a month right now. If I'm looking at a building and the rents are $1,200 a month, then that's a margin that I can build on, right? So, and there are things in Los Angeles right now. Rent control is in California, so I can only improve it so much. So you really have to model it out. How many units do I have to turn every year to capture that market rent? Do they have inefficiencies in their operations? Do they have a pool that's sucking a lot of water out of the yeah?
And are you utilizing rehab those units to then be able to jump that?
Sometimes. Sometimes, yeah. For sure, if we turn a unit, we're dumping $10,000 into the unit to rehab it. But I guess before rent control, I didn't have to do that. I would raise rents and people would just stay because there aren't any places to live in LA. So, I mean, it seems unfair, but I'm only charging market. If you were paying $500 under market, you probably understood you were getting a pretty good deal for a while. Well, new ownership's in town. We raised the rents up to market, and the majority of people stayed. Well, rent control is there now, so my business plan has changed. Now what I'm doing, instead of trying to get people to stay so I don't have to put that capital down to rehab, now it's all about kicking people out, for lack of a better word. We charge for everything now. We charge for a parking space. We implement a utility reimbursement program so that we get if we're paying for gas or water, we charge that to the tenants, and that's outside of the California rent control. So when we're looking at a property, I'm looking at that. I'm looking for margin. I'm looking for an amount that I can improve it and make sure that I'm not paying too much for it, because a lot of times a seller is going to overprice their property or overvalue their property because they think it's gold, and it is gold. But if you haven't done the work to maintain and manage your property and keep it up to, and basically keep your rents up to market, when you're talking 12 or 15 units, these are businesses and they're valued as a business, which is on a cap rate. How much money can you make if you were to pay this whole thing cash? What would your return on investment be? That's the cap rate if you haven't heard that term before.
So what I'm hearing is basically that you're looking at these underperforming assets, and the most important number to you is net operating income, what it is currently, and then the future net operating income. So those are, with those two numbers, you can figure most of this out. So how do you figure out the future net operating income? Is that something that the broker supplies you, or is that something that
The brokers try to supply that, but just like Bjorn was saying, if you're talking to a syndicator and they're saying I can get $1,200 rent for this studio in Austin, Texas, do your own homework. I do. I invest in all of my buildings along with my investors. So I'm doing my own due diligence on this as well, not just for my investors, but for myself. So I'm checking, and at this point, I know the markets because I've been doing it 12 years in Los Angeles and Orange County. I know a property in Downey, if it's a one bedroom, I can get $1,800, $1,850 for a one bedroom. A two bedroom, I'm gonna get $2,200, $2,300 for it. I know that now. So there's a little bit less work there, but if I'm going to some place like Garden Grove, which this is my first building in Garden Grove, I'm doing a rent survey. I'm talking to property managers that run properties in that area. I'm checking on, apartments.com. I'm checking on, I'll go to Craigslist. I wanna see what the cheapest one bedroom or two bedroom apartment is in the market. Because if I can't hit my target, I at least need to hit that bottom number. So that's the work I'm doing to make sure that the numbers are there. Then I'm looking at average selling price or what the last couple deals have traded for. If in Garden Grove the average sales price of an apartment is $330,000 per unit, and I'm getting it to $270,000, that's probably a decent deal. Then the next step is, if the numbers work, we go drive the property. We go kick the tires on it. We look at the windows. We look at the roof. We're walking around making sure that what kind of plumbing it's got. Do we have galvanized going in? Do we have copper going in? Have they put some of that work in? Are the eaves all rotted from termites? And you can tell a lot about what the prior owner's done for a property just by walking around the outside. Yes, you're going to get into the unit. Yes, you're going to see some horrible things in apartments, especially when you're buying like underperforming value add workforce housing buildings. If you're buying from a slumlord, they are treating their tenants like crap, and I've kicked out more cockroaches than I've kicked out tenants. So. And I sleep well at night because of that, because I really am improving people's lives.
The good tenants like it. The people that stay, they're like, I'd gladly pay $500 more a month in rent because you put security cameras on. I'm not worried about my kids. It's not like, there are some bad syndicators out there who just don't add those amenities, but yeah, exactly. But the good ones do make the tenant experience better.
Amy, go ahead, please.
Sorry.
Yeah, no.
So you were talking about earlier how you were interested in starting investing in Oregon. So with living in California, then is it beneficial for you to have a broker that would go and do those things?
I actually live here.
Oh, you do live here?
I live here.
Okay.
Yeah, I do all my acquisitions remotely. I fly down to LA maybe every 6 months, but I have family down there. They manage the actual construction management and turns, but I live here.
And you do want to have a trusted person on the ground, like he obviously has family.
Yeah.
Right. Okay. Okay. That's it.
And last question for you then. So again, back to your buy box. You said you're mainly looking at B minus C plus. No, what class? Like, and describe what that means to some. Where does that fit on the continuum?
All right. So property is like you'll hear the terms Class A, Class B, Class C. Class A is usually like a new development, higher end property. Class B, you might be talking about like 80s, 2000s product. It's got some age on it, but it's still in pretty good condition. Class C, that's older stuff. That's workforce housing. That's value add properties, things that and it's all a guess on some of that, like how you classify it. My terminology may be different than Bjorn's terminology or James for what he's seeing here, but tired, old, that's C minus. Putting some fresh paint, a new roof on it, and kicking the bugs out and the drug addicts. You've
So you do have some of that in C's, and I know, James, you said you like the D's, and I've heard a few stories, but describe what takes it from a C to a D for you.
Yeah, so I think the D really comes to like that situation where you got drug addicts living there, you've got maybe an entire building full of sex offenders living there, you've got, which I have bought one of those, you've got maybe hoarders who are living there, those kind of things. So the tenants are just really, really rough people and maybe hard to get out, and as a result, they put a lot of wear and tear on the building. So I would say like it's similar to that C minus, but one where you may have trouble getting financing for it because there's some other big issues with it.
And would you ever consider looking at a D class in other markets that you're not as familiar with?
Ooh, me, probably not. They're just riskier. They're a lot riskier. And I think as a syndicator in charge of other people's funds, I do not have enough experience or either about like actually doing syndications about a specific market of that size to go after it. I think I'd be a lot closer to do a ground up development than try to do a D one first.
Outside of
ask me 5-10 years from now and I may change my answer.
Yeah. Really?
James, is that just a D class building or is that a neighborhood?
Ooh, that's an interesting question. I'd have to think more about it. Probably the neighborhood as well, if I'm being honest.
Okay.
Just because there's a lot to overcome with that. And obviously, and we're looking for markets that are at the very least stable, but ideally growing on an uptick. One where people want to move there for whatever reason, and so a D-class neighborhood that you don't have that, and so you're fighting a tidal wave there. And even if you were to make it amazing and make it an A-class, like you're still not going to get the type of people you want. The returns aren't going to be there, because when you're doing like that rent review, you're going to find that like the numbers just don't work out.
So I've got some stories about D-class neighborhoods. We stay out of the D-class neighborhoods. My company does, because you can do everything you can to your building to improve your building, but if the block around you is horrible, how do you realize your value? How do you get your profit out of that? And you guys know Carl's Jr., right?
Yeah.
Okay, so the guy who owns Carl's Jr. Tried to change a neighborhood of Anaheim, bought 4 or 5 apartment buildings. I think the name of the street was La Palma in Anaheim, or right off La Palma in Anaheim. And it was a complete failure, and because he couldn't change the neighborhood. He tried, bought a couple properties around and fixed them up, and then ended up losing a lot of money, and those properties were trash by the couple years after he sold them. So it's really hard to change a neighborhood. It takes a little bit more than a syndicator to do it.
And there are so many other great neighborhoods and deals. It's just why?
What?
And it's my opinion is find a B neighborhood that's got a D property in it. Find the ugliest building on the block, and if you bring it up to, you don't have to make it great. You just have to bring it up to where everything else in the neighborhood is, and then you see some profit.
Bjorn, I got a couple questions for you. So, I asked Damien, what was the first thing that he looks at in a deal? Is there something that catches your attention or that you look at first? And likely numbers, since everybody on the panel is pretty analytical, but what number is that? And then are there times that those numbers have lied? Stories are welcome.
Yeah, I think the first thing to look at is to try to not look at the glossy marketing of the syndicator, whatever they're offering you. Because if you see like a lot of talk about the market, the neighborhood, the you know, I don't know what Corpus Christi is, you know, growing at X%, and it's nothing about the deal, and it's all about the market. And it's like, whoa, okay, what? I want to hear about the deal. So I flip right to the page where you look at the numbers, and of course this depends on, you have to first vet the syndicator and make sure that the numbers you're seeing are legit. So you want to make sure, I guess what I'm looking for is to make sure that they're not doing any crazy assumptions. That if they're saying 5 years from now, we think rents are going to be X, well, you don't want to have any assumptions about market growth. You want to assume that you can bring rents to where they are today, to the highest to where they are today, maybe the highest achieved in that neighborhood or the highest achieved on that site or for a comparable building. But if somebody's telling you, oh, we're going to grow 5% every single year, I mean, maybe costs will grow 5% every year, but rents, that's a big assumption. And I think you also want to see the exit assumptions. So a lot of these syndicators have been, in the last 10 years when we've been in boom times, have been saying, well, we're going to double your money with a cash out refi, and you're going to double your money, and it's a tax-free event. That's true if you can pull it off. So is there another exit? If you can't do a cash out refi, could you hold it for 20 years? So the question is, do you have long-term debt? So long-term debt's important, I think, because then it could be, if shit hits the fan, it's a long-term hold. Another exit assumption is, does the cap rate, so the assumption about valuations for apartments, are they assuming a worsening market? And so when I was interviewing syndicators, I spoke to at least 20 syndicators before I invested with one. And the reason why I invested with the group I invested with was because I had the same question for all syndicators, which is, okay, cap rates are at 4%. What happens when debt goes up? And this is 3 years ago when I was asking this question. What happens when debt goes above cap rates? And the first person I invested with was someone who gave me a smart answer, which is, well, that's negative leverage, and then shit hits the fan. Yeah, that's bad. So you want to find someone that is assuming the worst, that, is anyone familiar with Nassim Taleb? He's a writer, wrote Black Swan. So like, you can't predict anything. All you can do is mitigate risk. So if something unexpected happens, like, I don't know, a pandemic or Putin invades Ukraine or anything crazy, if something crazy happens, could you weather a storm? Do the numbers still make sense? So can you force the net operating income high enough so that it doesn't matter what cap rates do? Because it's all about risk-adjusted return. Because anyone can go and say, yeah, you're going to make 30% in this deal, but can you be guaranteed you're going to get your principal back? So yeah, I mean, in the return metric, you asked what I'm looking for. I think if you're going to put away your money for 5 years, let's say, if that's the average hold, I would expect that you could double your money after 5 years. I think you should have a reasonable expectation. So that's 20% a year. And I talk to a lot of people locally, and they're like, you can't get that in Oregon. Well, you can't because you're not finding these people, but there are those deals happening. But it's just, a lot of people are promising that, and they're not going to deliver with what's happening now. A lot of syndicators have gone a little bit too far.
Can you describe a little bit about, the term exit? I think most people probably understand that, but what that means and what kind of the range of exit plans, and James too pipe in, but what kind of exit option, what does that mean? What does that look like?
Yeah, I mean, cash out refi, so you get the NOI up, the net operating income up, and then you refinance the deal, and you can get,
So it's the burst strategy of an apartment building.
Yeah.
Or you can flip an apartment, so in 5 years you sell it, or you could do a long-term hold. And all these things, all these exits have tax implications, and where do you put the money after that? And that's a whole different meetup we could do. But a lot of can of worms there.
Okay.
As a general rule in syndications, it's not holding on for 30 years. It is that average of 5 years slower, get a higher velocity of money going, add the value, sell it or refinance it, and then move on to the next value-added project.
Okay. And yeah.
I was gonna say, when you're looking, let's say you're looking at the numbers and you're looking to see you want that 20% every year, how do you tell between someone that's pushing numbers, that's pushing really far, and what's conservative and what's accurate, I guess, especially if you're trying to forecast or project what the next couple of years are gonna look like?
I would say talk to references of that syndicator, and then just make sure they're not having crazy assumptions. I don't know. I mean, talk to references.
I mean, you said you looked at 20 before you invested in the first one, right? I mean, so you got to see a range of how people were estimating things.
Yeah, there's a lot of people that were like, "Oh yeah, we got this, bro. We're gonna." I mean, literally said "bro" on the interview, and like, "Oh yeah, we're gonna." Because we did the last 10 deals, we did this, we're going to do this again. Like, okay, you control the economy. Like, I think, is the operator focusing on things that they can control? Like, you can't control the D neighborhood. So like, what can you control? And that's, I think, what you need to focus on. And then knowing the references can say, oh yeah, they did this. You want to make sure that when you talk to the references, it wasn't like, you want to talk to repeat frequent flyers like, oh yeah, there's that one deal, I wish I would have put more. I think that's the key word, is like, you want to hear someone say, oh, I really regret only putting 100 grand on that deal. Those are the magic words, I think.
Nice. And then, the red flags, I know you've got a story or two about red flags, but you mentioned too rosy of projections, especially once your rent stabilized, that continuing to increase 5% or more per year. Tell us is this a good time to tell us a story about, I think, the Texas?
Oh yeah. So my wife, her brother-in-law is a spine surgeon in Corpus Christi, Texas, who from 2009 on is a real estate genius. He's been crushing it as a limited partner. So he'll put 200 grand in this, 200 grand in this, and he's crushing it. So as a limited partner, totally passive, he decided, I'm going to be a GP. So last year he sends my wife this deal and says, you guys really need to invest in this. And so my wife is like, he's done really well in the past 10 years. So that's a big red flag. It's like, the hot hand fallacy. Just because someone did well in the past doesn't necessarily mean they're going to do well in the future. So I look at the deal and I'm like, it's 15% rent upside. So you could boost rents 15%. And I'm like, that's not bad, but it's not good. And I looked at the neighborhood and I pull up CoStar and I start doing my due diligence. I'm like, oh, that's interesting. 10 apartment starts right in the neighborhood. But Texas is a hot market, I hear on podcasts. Yeah. Texas is great. Texas is landlord friendly. I don't know, if you're buying pre-built, LA looks pretty good. I mean, for example, like they're not building any new inventory. And I'll give you an Oregon example. Would you rather invest in multifamily student housing in Corvallis or Eugene? I'm going to pick Corvallis where they're not building enough units. So I think okay. So anyways, the red flag. So my wife is like, we got to do this deal because Andy did so well in the past 10 years. So finally, I just start looking at the deal and picking it apart. And I ended up investing in a deal in Lebanon that was okay, but it was better than a deal in Texas, just so my wife would stop saying, we got to do this deal because it's a hot market. It's Texas and they're pro-growth. I'm like, okay.
So when are you going to go back and check the returns of that one?
They lost their earnest money. They didn't fund it.
Ooh, bummer.
They did not fund it. So.
I think it's for the best. Well,
Can I add one thing to your question about numbers to look at? So what Bjorn was saying was look at their exit assumptions. That's another thing to really look at. So when I'm underwriting a deal, if the cap rate in California where I'm buying is 4%, I always add 50 basis points to my exit assumption because you can't predict the future. Look for operators that are very conservative in their underwriting.
So my experience is that every single deal that I've heard, the operator says, I am super conservative with my underwriting.
Yeah.
That's their first part of their pitch. So how do we know that it's conservative?
Dig into it. Okay, what does conservative mean for them? If market rents are $2,000 and their pro forma shows that they're able to achieve their returns on $1,800 or $1,850, That's conservative. If the market is 3.7 cap rates, but they're saying, nah, we're going to go 4.2. That's more conservative. And then their exit is even more conservative than that. Have them do a sensitivity analysis for you. It's like, what happens if you don't hit your rents? What happens if the economy tanks, and what happens with vacancy? What did this market do the last cycle? Because all of real estate it operates on cycles. Texas didn't do so great 10 years ago during the last downturn. I'd be scared to death, except for maybe Austin, to invest in Texas. But that's just me. So ask the operator, if they're saying they're conservative, tell them to point you where. Where are you conservative? Show me the numbers. Where's the margin you're taking that shows you're conservative?
But we've got a really good rate on that 5-year loan, so don't worry about it. It's like it's like those little things like the debt. Like, are they being conservative on the debt? Are they conservative on everything? Yeah.
I have a question about the refinance thing. So initially, the GPs are financing for the investors, essentially.
Yeah. You'd have the general partners or a key partner on the general partner side of the stack, and then the limited partners it's like pooling down payment money.
Yeah.
And so the general partners may or may not be in the loan, and the key partner would be in the loan. Sometimes they're overlap, right?
Yeah, there's at least one person that the bank is looking at on the GP side of things that has enough assets to, cover the loan. Is that?
But when you refinance, that's just freeing up that money, or how do we know that the refinance money is cheaper money than the original money?
I think a lot of syndicators are gonna find that out, because there are a lot of folks in these hot markets that were like, we're gonna refinance in 5 years, and we're not gonna buy that rate lock, or we're not gonna pay a premium for or they're not gonna get long-term debt, and so that path is closed. And I'll give you an example. I won't name names, but there's a deal in Albany that a syndicator out of Southern Oregon bought it, and they told their main investor, so the limited partner who's like, yeah, I'll be the only investor, and I'll put down all the cash, and we'll just refinance it. And they used Southern Oregon assumptions on some of their costs, and they didn't have property management here, they didn't know contractors here, they didn't know the subs here. And so as of January, they decided we better refinance, but they hadn't completed their turns, and all of a sudden they're stuck because interest rates went up. And so that's when I started talking to them about selling, because they're like, we're screwed. And it was a good deal on paper.
Yeah.
It was a great deal on paper, and
One that got away.
the one that got away. And so many of you in this room probably. We had a few offers on it.
Tried, but it's all right.
Yeah.
I know at the conference you went to, there was some talk about opportunities and/or where some of these other people missed the mark. But where are you seeing some of the opportunities? What did you learn as far as what might be happening in the broader market, James?
I think I understand your question.
Yeah.
Texas is still pretty hot. What's the other one? Hotlanta, I like to call it that. So Atlanta's another big one. Louisville, Kentucky is a place, shockingly. And again, it's not even just the markets, but I've talked to a lot of syndicators who are looking into that energy space, just because it's relatively untapped, because apartments have been so strong, you haven't had to. And so there's that kind of diversification happening. I also know, again, storage units is a really big one because it's counter-cyclical to the market. And so there's people who are anticipating a downturn, saying, all right, we're going to get into storage units, so when people lose their homes, they have a place to put their stuff, and it's going to be ours. And so I think those are the big ones. Surprisingly, no one was interested in Oregon. They kept saying it's not a tenant, or it's not a landlord-friendly state.
But that keeps other investors out and more opportunities for you, right?
That's my attitude.
Ask them, why is it that the biggest buyers in Oregon are all out of state capital? The biggest apartment buyers in Oregon are, big money, smart money, family offices, hedge funds. Yeah.
Yeah, no, I'm with you.
You're sold. Preaching to the choir.
So one of the things that I thought was interesting that they talked about was that a lot of people that were operators, and this goes off of Bjorn's remarks, is that a lot of them got hard money, or in this world they call it bridge financing, meaning, hey, I'm going to get some short-term, high-interest loans to do my renovations, and their projections were being able to get the same interest rates that they could a year or two ago.
Bridge to nowhere.
And that's probably the term for it, bridge to nowhere. And now as they got their property stabilized or their renovations done, they're realizing their costs are way higher on the debt side of things too. So it sounds like there might be some distressed apartment sales and or from some of these operators, but not enough to probably skew the market too much. But it's going to create opportunities for other people with the capital to come in and swoop in and buy it up.
What I heard from someone in SVN is a national firm. I heard from someone in I think it was in Louisiana or like some southeast state, and there's a buyer down there who hasn't bought for 3 years, and somebody asked him why, and he said, "Well, I'm waiting for all these syndicators to sell because people have been overpaying with." It's fine to overpay in a deal if the upside's there.
Yeah.
But people they were overpaying, and there was like 10% rent growth. And you need, I think, 40 to 50% to really have a slam dunk and safety, I think. I mean, maybe 40% is too high, but those deals happen. We just don't hear about them because there's all this off-market stuff.
Well, you're not going to find a property that has been all fixed up and rents are still 40% under market. And all you got to do is go in and operate it well, and get good property management in there. Like, those don't exist. It's genuinely, it's this C- property, and it's at market rent for that property, and the value is in repositioning it, and that's where you're going to find your 40%.
Yeah.
And we just take more work, but yeah, they're out there.
So we've talked, we've been focusing a little bit on risk. There's lots of other things to do and to look at for due diligence. Talked a little bit about returns, but what about costs? What does that look like from the investor side of things?
Like fees or?
Yeah, fees. How does, as a general partner, how do you make your money? Or where does that come into play? What kind of fees could somebody expect?
Okay. I think you're talking about like the waterfall, or you're talking about like evaluating the front end.
Acquisition.
So yeah, most syndicators are going to have an acquisition fee that 2%, 1.5%, something like that. That's to keep the lights on, because syndicators aren't making money on the acquisition fees. You're going to see probably an asset management fee, and there's going to be a construction management fee. So those are kind of the standard fees that you're going to see. You may also see other fees if they have to go out to the broker-dealer network to get capital. So they will pass that fee on to the asset if they have to go and pay 5% for someone else to help them raise money. So those are kind of standard syndicator fees. Asset management's usually like about 1.5%, and that's on a monthly basis that the syndicator, and again, it's not even enough to keep the lights on usually for a property, but that's on there.
The other fee that's related is so a syndication, you're technically selling securities, and so you're stepping into security law, and so there's some documentation around that. There's a private placement memorandum, and you got to have your operating agreement and all sorts of stuff, and that is not cheap. And I mean, it could be upwards of like $40,000 to do just all that paperwork. And so that's another reason why syndications tend to just be for larger properties, because you got to make those costs negligible. Like if you're going to syndicate a single family home, oh my gosh, I'm going to pay more for the paperwork than the down payment. And so that's another one that syndicators don't earn that, but it is a fee to invest.
I was talking to, just on the fee point, I was talking to one older owner in south of here, and he was talking about, I was telling him that I invest in syndication. He's like, oh, but the fees are so high. I was like, well, what's your property management fee? And he's like, oh, I pay my gal 10%. I'm like, well, we have vertically integrated property management, and we're paying them 4%. So you got fees, but you also have economies of scale and scope that a good operator has. And one little Easter egg in what you said, Damien, you have all the brokers calling you. And so when I was trying to find duplexes to buy to get started, because I want to start small, I wasn't getting deal flow, because even if I had a large down payment, but brokers are like, first timer, no, I'm going to go to the guy that I've done 10 deals with. So in this business, deal flow is everything. So either you are a broker, or you know all the brokers and have them sending you leads, or you have to do something creative like syndications. So it's all about deal flow. Or you could do a direct mail campaign, which is a lot of work.
Hey, James. Those SEC fees, is that for every deal, every property, or you just have to do it once?
Technically, you could create a fund that invests in multiple properties, but that's typically not how it's done. You're creating a single purpose LLC and you're selling securities to that LLC for that particular property, for that group of people. And then when you find another one, you form a whole new LLC for a new set of people, new sets of paperwork, new fees and expenses. That's the typical way that it's done. But again, there are some operators who will say like, hey, we're opening up this fund and we're going to be raising capital for the next 6 months, and the goal is to buy, X number of dollars of real estate of this type, this whatever, and then that's one way that you save. But it's a little more. There are more rules when you have a blind fund like that, and so most syndicators will just say, yep, we'll just wait until the deal's ready. And honestly, they don't even start. Like the LLC gets formed when all the closing documents get signed as well, and so it all kind of happens on one day.
So is there sort of a general floor? Like, these things start at, say, $5 million. And is there just like a general sort of...
For a syndication?
Yeah.
No.
That makes it sort of work.
I wouldn't say there's a floor.
Probably don't see too many under $1 million, and probably not too many under $2 million.
That was where my head went. I feel like that 1 to 2 million's going to be your effective floor just for that reason. I mean, part of it depends too, right? Like in theory, you could do a syndication with family and friends on a fourplex, and you could not do the paperwork. I don't recommend it, but that's a way to save some money, because you all have an agreement, like that could save it, so you can go smaller. But yeah, I don't know. I put in like that 1 to 2. At least that's been my experience for what I've seen.
Question, do you necessarily have to do under the LLC, or could, in that example you're talking, set up like a corporation, S-Corp, whatever, and then have LLCs per property that then the S-Corp is the member of the LLC and route it that way?
I'm not exactly sure what you're saying, but I know some of the crowd funds will invest in syndication deals with an LLC, so it's an LLC within an LLC. My company operates as a C Corp DBA, and then my company signs on the loan. Our principal signs on the loan, and then they are the manager of the LLC syndication deal that we do out to sponsors or out to LP members.
And you can hold property in a syndication in an LLC. So all my positions are in my LLC, just so it's one added layer of asset protection or paperwork or whatever you want to.
Main LLC within your sub LLCs to that.
There are so many ways you can make it complicated and
I was escrow officer for 18 years, so I've seen signature blocks. And then we fraction out to
Yeah.
And so to create those, you get really complicated.
You have to be careful that you're not just solely selling securities to a company, because that is a totally different realm. And so the nice part about the structure of saying we have an LLC that has multiple owners, some of the owners may be individuals, maybe LLCs, maybe C Corps, that keeps you out of trouble with the SEC. If you start to say, no, we just got one big company and just invest in us and trust us, and sometimes we're going to buy property and sometimes we'll buy a boat, I don't know, that is a difference. You want to avoid that.
Yeah. So, okay. So that was thinking the structure to have those fees under one primary and then LLC for each property that has different members. So you're saying we need to do fees per individual LLC.
Right. There are ways to get around it, to just do it once. It's more complicated, but
yeah.
So I can chime in a little bit here.
Yeah.
There's slight differences and nuances between like the syndications and the funds. With funds, a lot of times what will happen is you'll have the LLC that goes and buys properties, and you'll have whoever the GP is per se, or whoever the fund manager is, and they'll own a portion of this LLC, as well as the investors will own a portion of this LLC. So for example, you might have like the fund manager own 30%, whereas the investors own 70%, and then that would own, whether it's in one property, you'd own an LLC that owns a property, or it would own multiple LLCs that own multiple properties. And that's also, that might answer some of his questions, but that's also partially dependent on whether you were creating a fund that's going to go buy multiple properties, like, hey, 6 months in the future, or if you're creating a fund that's going to buy one property, then you've already pitched exactly what that property is. Does that answer your question?
Yeah,
Or is there-
no,
is there
that's
more
more,
on that?
yeah, that's more.
Okay, and then also with the floor rate too, with the syndication, you might do like a lot of joint venture agreements, and you could have, like he was saying, you might have family, friends, you also could be doing like a tight knit group that you worked with for a while, or you might be the GP and you've met all these people over these years, and you can just write a contract between you. But with a fund, that's where you're typically going to have a very high floor because of all the different legal fees that come along with it. There's, there's slight differences in like legal fees and nuances. Obviously, with like 506B, 506C, and all the documents that you're going to have created for you. You're going to want to have a floor.
It sounds like you still got to pay that $40,000 if you're doing it family and friends.
You call it a joint venture. So, Damien's got about 5 more minutes, and so especially if anybody's got questions directed to him.
Early on, I feel like you said that your company will sign for a loan, and then you will sell shares of the LLC after the fact. So I'm a little more familiar with hearing people raising the capital for the down payment. Are you doing that, but your firm is putting in all the down payment, and then you're selling shares from?
No. Maybe I didn't nuance my words properly. So if close of escrow is, let's say close of escrow is in 30 days, we're signing on the loan, close of escrow. I'm fundraising up until close of escrow. I'm hoping I get enough down payment, or generally I'm raising enough for the down payment to close escrow. Maybe there's a couple shares left over that can continually be fundraised after that. And also, James, maybe his experience is $40,000 to put together a PPM and an LLC. I'm paying a fraction of that.
Yeah,
so,
that's the worst case.
Yeah. So if you're using 40K as a benchmark, to okay, well I've got to block in that amount of capital for that. You might be able to find a lawyer that'll do it for cheaper than that for you.
But I get to claim I'm being consorted in, so.
Yeah, he really is being conservative already.
Yeah.
Scott?
You disclose the ownership interest publicly. You create all these legal documents. Do they go to any government agency?
Yes. Yeah, we do a blue sky filing at the close of escrow. Once the deal is fully funded, you have to do a blue sky filing for every state that an investor is investing through.
So if I wanted to find out about your families or your groups, syndications, could I go and find that somewhere on a website somewhere?
Yeah, you can find it on the Secretary of State. With the Secretary of State, like all of our LLCs are there, and then you can drill down. If go for the address of the property, find out what we bought it for, find out what we sold it for, and I would say that's another way to prove out a syndicator. Like, are they doing what they say they do? If they're sending you a track record, what is the LLC name? Go to the Secretary of State and find out. Make sure that one of their principals did actually sign on that on that acquisition, and then go and pull a CoStar report. What did it buy for? What did it sell for? Does their story match? Did they really make $5 million on the property that proofs out that they were able to deliver a 20% return?
Call the brokers, call the title companies. When I first met Damien, we happened to know a broker that I knew from high school, and I was like, hey, does this guy really close out of deals? And he's like, oh yeah, he's legit. So I mean, brokers know who's doing deals and who's not.
I'm not sure if you're asking about the investors in the deal. That is held private. So we do not disclose who is invested in any one of our deals. That is protected by the LLC.
That's not disclosed.
No, the investors in the deal are not
interest
disclosed.
of the limited partners is not disclosed anymore.
The limited partners, their names are not disclosed now.
You buy shares in LLC.
Even for like tax filings? Is there, I guess, do you have to report to IRS?
Oh yeah, yeah. Every year we deliver a K1 to every investor, so yes, the government knows who's invested in all our deals, but it's not posted on a website for the general public.
Because it's not publicly traded?
What? No, we're not publicly traded.
Right, but that's why, right? Yeah?
I don't know that answer. I'm not sure if like GE has to, if I've got 10 shares of GE, I don't know that they post my name on their website either. I don't know.
I think you're only required to, like, there's a certain threshold where they, percent ownership, but otherwise, no.
Yeah.
Is there some kind of lockup period? I mean, what's the exit strategy? Someone invests 6 months later, hey, I want to do something else. Is there a buy-sell?
No, there's not an open market for syndicated deals generally, but you can sell your shares. You just have to find someone that buys them. And there are, like, I'm pitched companies all the time. They call me up and say, hey, do you have any unhappy investors? And they'll pay you pennies on the dollar for your shares.
And there's some in the operating agreement that you sign, there are some that say, here's the price, like, 80% or 90, like there's sometimes they'll prearrange, like if you want to bail early. But that's like, I don't know, there's syndicators also, I don't know, I assume you interview your investors too. It's a two-way street. You don't want to, money's actually easy to find. So deals is hard to find. You want to find people that are also patient money at least. Yeah. Like before I invested with these syndications, they were like, they called around people and tried to find out about me independently. Like, is this guy, is he in a marriage that's going to blow up, or is he, like they were like wanted personal references. Like, am I going to panic and say a year later, I want out of this deal? And like they want someone that's going to go through to the end. Patient money.
So you should consider it liquid for, it could be up to 10 years.
Yeah.
2 questions. Who's putting your paperwork together for like creating the syndication documents and then like, I don't know what you would call it, prospectus?
I do my own marketing materials, but I do have a lawyer that puts together our PPM, our operating agreement, and our subscription agreements.
Oh, and then software.
For investor management, I use Juniper Square. So they're a nice company. Their app is pretty great. Sits right on our website. So when the investor comes to our website, they log in on our website and it looks like our website. So.
But there's been an explosion of options in the last few years. So there's a ton to choose from. If you just search for, I think it's like passive investor portal, something like that. There's a ton of options out there.
AppFolio is another one, and they're cheaper. They're a lot
Which
cheaper.
one?
AppFolio.
What does it take for us to give you our money and invest with you guys?
Well, we've already talked, so you're on my list.
So for my company, it's our minimum investment is $30,000.
And you keep a list of investors that when you do have a deal in the pipeline that you start sending.
Oh yes.
That's yeah.
Even if you're not actively investing, I think it's good to be on buyers lists because it's great information to see like deals happening in the market and just see like just what their underwriting is. Todd, you had a question?
Yeah, so like Damien, when you say your family's done like 50 deals, is that like, so it's you're at your own syndicator, like you don't go to a platform like CrowdStreet or?
We did go to, well, we went to CrowdStreet to market our deals, not to invest in it.
Yeah,
we were on CrowdStreet.
That's something because they kick out a lot of sponsors.
My
son works there, they vet a lot of sponsors.
Who's your son?
Jason Powell.
Oh, okay.
So he leads the advisory section. So he represents about 6 to 8% of the revenue stream. So he deals with the $10 to $50 million network people. The other thing I was going to say too, James, you mentioned accredited investor. One thing that wasn't said, the $1 million net worth excludes your personal home.
Oh, yes.
So that's a big one because a lot of people's greatest wealth is their house.
Yeah.
But they exclude that. They don't allow that. So it has to be $1 million. Just wanted to add that.
Yeah, no, thanks. Yep.
Before you take off, do you want to include do you want to tell people your email address or anything, or do you want me to send it out afterwards?
Sure.
So you can people?
Syndications, if you don't know where you're putting your money, they could be on American Greed.
Yeah.
And there's a lot of great salespeople.
Yeah.
And you have to really, you said the operator matters more than the deal or the location. I kind of think all three matter to me.
Yeah.
To me.
In that waterfall, yeah.
But I think the operator is the key. You really have to vet the operator. You have to know, because I have one syndication that's great, one that kind of went flat.
Yeah.
So to me, I like to control my own deals, my own cap rates, and not put my faith in other people.
Yeah.
But I know why syndications make sense, right? People can pull their money, not have to deal with it.
Yeah.
But it's interesting.
And it doesn't have to be the be all end all. It's not like you're only doing syndications. It could be like, oh, in my retirement account, I'll do 25% syndication. So it's, take care. Yeah, I think maybe geo diversification or, as part of a portfolio, I wouldn't recommend it as like, oh, all I do is that.
Sorry, making me get it.
So how is the decision to sell made? Is it when you hit a certain return, the general partnership makes a decision, is there a vote? What's the process to trigger the sale of the syndication?
Yeah, so technically as a limited partner, you don't get a vote. So the general partners will make the decision, though a lot of them will do a straw poll, kind of put it out, hey, we want to get a sense for where the other group is at. But it is typically, we've got a certain investment return metric that we're going for, we hit it, and so now we're going to dispose of the property. And it's at that point too where, and every year there's an annual evaluation of, okay, does it make sense to refinance or to sell? And it just kind of, it'll depend on what the greater return metric is. And so, and again, it usually comes out to like that 5-year point is where you've hit the max on terms of that value add, you've peaked out on that. And yeah, you can hold on to it, but the incremental return just isn't quite there. It's better off to sell it and move on to a new value add deal. It's typically what happens.
Are the general partners allowed to flex based on changing conditions? For example, a sudden rise in interest rates, you can change sort of
Absolutely.
targets. They have full control. Is that correct?
Yeah, the only time like a limited partner might step in is where there's something going wrong with the GP. They're making poor decisions, or there's questions of integrity, and so there might be like a no confidence vote, that kind of thing. But yeah, the general partner in general has a lot of flexibility in how they manage it going forward. But as Bill was talking about, like for future ones, for references, you might have someone say, well, yeah, they said they were going to be out in 3 years. But I was in it for 10, and they said the returns were going to be this, and they technically were, but it took an extra 5 years to realize it. And so that's just a balancing act there.
So if I'm trying to evaluate a syndication, and there's a lot of, it seems like the general partners have a lot of flexibility with my money, that's not unusual.
Correct.
Yeah.
Yeah. And I think another vetting piece too is you want to see that the general partners have some skin in the game, because they have an incentive to try to maximize and make the right decisions. So they're aligned with you.
At risk capital, yeah, and it varies like how much people are putting up. But you want to see that it's like the in ancient Rome they made the bridge builders and their families sleep under the bridge that they made for a year. So there's like aligned incentives. So if they're not getting paid until the certain return metric is made, so that preferred return, it could be 8%. So before the general partners get paid their X%, we're going to make the limited partners whole up to 8%, and then beyond that, it gets really complicated. You could have a million different things, but the at-risk capital is key. And if you see somebody who's like just trying to do deals, and there's this hot deal in Texas or Tennessee or Florida, whatever the hot market du jour is, and they have 10% skin in the game, that's less attractive than somebody who has more skin in the game. I don't know, but yeah, you want to make sure the incentives are aligned.
Got just a couple more minutes for questions, but as we get into some final questions, I want to ask, especially James, since you've been on such, and I know you dive so deep into research, what are some of the best resources that you've found for investors, whether that's books or podcasts, and what are some of the best resources you found as far as learning about operating syndications and or fundraising and those components of being a GP?
Yeah, so I would say if you are interested in becoming a syndicator, probably the best book is by Michael Blanc. It's a yellow book, and I think it's something to the effect of like real estate investing for financial freedom, something like that. But if you look up Michael Blanc, which looks like blank, that's a fantastic book. If you're interested in doing it yourself, he gives a great overview, and then he's got a companion mentorship course thing that you can sign up for, which I did, which is also fantastic. If you are interested in potentially being a passive investor, a great book is called The Hands-Off Investor. And on the cover, there's like a little piece of tape covering on the hands-on to say off instead. And that just gives you a really good overview. Again, also the entire process, but from a passive investor standpoint. So it's like, here's terms you should know, and here's kind of the overall process. Here's how you should evaluate how a sponsor is underwriting the deal. So just another good book. That one's big. It's like 400 pages. It's a read. But those are two really good resources to get started. And then I've noticed there are spots, if you know how to look on BiggerPockets, where people talk about it. It's less obvious. Like I've noticed a lot of the BiggerPockets podcasts, like their main one recently, they've been talking a lot about syndications because they got Matt Faircloth on there, and he's got a really good book too, actually. And he's a syndicator, and so a lot of the stuff that he's been talking about is all about syndications. So those are some of the resources that I would start out with.
Yeah. Jordan, anything to add?
I was going to say the hands-off investor, and then just anything on value-added apartment investing or whatever asset class. Then podcasts. I think podcasts are a great way just to hear ones that have a lot of guest speakers. And there's some too, like Rod Cleef. I forgot his podcast, but he gets into mindset too, and he'll have interesting guests talk about partnering and who has what strengths to bring to a partnership. I would say just find podcasts.
Excellent. And then the only other one I would add is on the sponsor side, you can have different roles in it. So you can have the person who is kind of on that more operator side. They're underwriting deals, they're finding deals, they're again underwriting it, making sure it's a good deal. And then you could have someone who could also focus on the capital raising side of things. That is a totally different skill. And for that one, there's a guy, Hunter Thompson, who is the best in the market in terms of teaching, and he's got a great book. I think it's called like Raising Capital for multifamily real estate, something like that. But Hunter Thompson, he's really good, and he is solely focused on the capital raising side of things. How do you find those investors, make those connections? What's that process? He's a good resource for that. If that's something you're like, yeah, I'm not as interested in the numbers or underwriting, but I love the idea of doing investor relations and reaching out and meeting people. That sounds awesome. That's a great resource for that.
It's interesting to hear from Damien because he wears so many hats as an operator / GP, but a lot of GPs, from what I've seen, really segment more of, hey, my specialty is in the fundraising, or my specialty is in the deal finding, or my specialty is in the XYZ. So there's several roles in that too, and so you can absolutely find your niche as well.
One more book. So the Hands-Off Investor, I think, is like the best book for investing in and vetting syndicators, and then the most comprehensive syndication book, if you're thinking about syndication, is the Joe Fairless book, like the best ever.
It's
kind of hard to find, and it's pretty expensive, but like if you just want.
It is on Audible.
Is it?
Yeah.
Good. That one is really good too, so it should be on the list as well.
Any other, a couple other questions, and we'll go to our general networking part. Yeah, Mia, coming.
Back to where we were talking about finding the properties and actually running those numbers. Is there software programs that you like for that?
Excel.
I had when I was in my analysis paralysis phase, when I was like trying to find a duplex and running numbers, I created this massive I used to sell Excel automation software. That was what I did. So like I'm an Excel nerd, and I have like these great macros and all this Excel stuff. And each property I look at, as a broker too, I usually just start with a fresh Excel. And because when I'm plugging in numbers to a template I'm already using, then I might just forget something that wasn't, or you might overlook something. I like to get fresh in the numbers, so I kind of recreate Excel each time, and then I have different metrics I look at on the return side and plug it into, various underwriting software for brokers. But on the investor side, I don't know what you.
Yeah, I don't know. I'm weird. I downloaded 2 other ones, like pay money for them, and I'll use them, and then I rolled my own, and I'll use that and try to triangulate, see where they're different, where they're the same, that kind of stuff, because each one have different strengths and weaknesses.
So you kind of created a hybrid that you like?
Yeah, I may or may not be undertaking that little project in a month or so, but just because I think it's fun. I enjoy working in Excel.
Yes.
But there are a lot of, there's a lot of options out there, honestly. One of them, it's Lone Star Capital. They actually, you can download it for free off their website, which their whole thing is like, we're going to show you how complicated it is, and then you're going to want us to do it for you. And that's part of how they also prove out their competency, which makes sense. There's another one, again, Michael Blanc has one for $100, the Deal Syndicator, the SDA, Syndicator Deal Analyzer. And for your $100, you also get an entire series of videos where he describes, here's exactly how to use it, we'll go through examples, that kind of stuff. And it's just nice because it's designed for syndications, it has a lot of the costs already baked in.
I promised a few people to talk a little bit about some of the tax benefits investing, and so Bjorn, do you want to, or do either of you want to, talk about?
Disclaimer.
Yes, disclaimer.
Sandwich.
Everybody's tax situation is different. Talk to your tax professional.
So from what I understand, like what's great about syndications as compared to REITs, I don't think you can get depreciation in REITs. What I like about value-added investing, and again, this is why like you have to talk to your own tax people, because I, as a real estate professional with 750 hours, I can pass, if I have a paper loss in the first couple years of a value-added repositioning, like it's kicking off paper loss. I'm taking that against my and my wife's income. So that's a massive advantage to me that like a lot of people don't get into tax considerations when they analyze deals. And that's specific to each person. It's below the line analysis that I think everyone has to do.
Do you look for deals specifically, or do any of the deals that you've looked at specifically say, hey, we're looking for, ways that we can do a big cost segregation?
It seems like a lot of people, I'll try first, then you'll have a better answer, I know. I think there's varying differences in a limited partnership stack. Some want the cost seg, some don't. But there's, I think, some different things to think about as well.
Yeah, again, on the conservative side, I don't look at it. But I always know that's an option in there. And so essentially all the cost segregation does is instead of doing your normal, 39 years for commercial property, you say, well, not everything is that. And so it'll go through and it'll identify, here's an oven, here's a stove, here's your carpeting, here are all the different pieces. And so then you break up this big monolith of a property into a whole bunch of pieces. It's expensive, it's technical, so you don't tend to do it on small buildings. But then it lets you essentially accelerate that depreciation out, and depending if you are generally going for that 5-year hold time, then a lot of that could make sense. But yeah, it also depends. But as for me, I'll underwrite and say, no, we're not going to do that. We're just going to look at it straight, and if the deal makes sense without doing that, awesome. And then we have the option to look into it later on. Again, that's trying to be conservative.
And that opens up a whole new can of worms, because if you are accelerating your depreciation, that changes your basis, and so you might have more depreciation recapture. So are you gonna 1031 your syndication interest into something else? Well, if you only put $10,000 into a syndication, what are you gonna 1031 into? So that's why I think if you're doing small amounts, maybe find a syndicator that you can invest with your 401k in. And then you don't have to worry about the capital gains.
And by 401k, yeah. So syndications, can take self-directed IRA money.
Yeah,
correct.
Depending on the syndication.
Some syndications will do that, and then also I know that some syndications will take 1031 exchanges in as well.
Yeah, and with 1031s, you can only do a 1031 with a TIC interest with a tenant and common interest. So sometimes you'll see with like somebody's a frequent flyer with a syndicator, you'll see some random person as a TIC interest next to the capital stack, and you're like, wait, who the hell is Joe Smith? And so the syndication you thought you were investing with, and then it's like, well, Joe Smith is the guy that's been rolling his equity back into every deal. He just repeats every deal. We're like, yep, I'll exchange in whatever you find me. And so you'll see these repeat offenders, but you have to be on the tick side.
Yeah.
Which is different. Yeah, see,
It gets complicated.
Yeah.
Okay. Other last questions? And these guys might usually stick around for a little while too if you guys have some specific things. So, well, thank you. And one last thing: if you guys do put your name on the list, I'll send out these guys information or come ask them. I promised Damien that I'd send out his information as well to people that were here. So make sure you guys sign in. And then I'll get that out. But please give a round of applause for panel member. We're doing okay. Yeah, if you do want to stick around, we'll be hanging out. And anybody sticking around, let's introduce ourselves too. Yeah.
Did I just volunteer?
Yeah, you stood up first.